am so excited to be here at BPCon with John Bowen from Equity Trust. John, tell me a little bit about yourself.
Yeah, so I've been with Equity Trust for close to 20 years now, and I met our company founder nearly 20 years ago. He started the company, this goes back to 1974, and what I learned at that time is that you don't have to be reliant on stock market investments in your IRAs, 401ks, and other retirement plans, and you can invest in real estate. And so that's what myself and our clients have been doing for a number of years, in terms of being able to invest with a retirement account, the ability to invest in rental properties, private equity type deals, real estate syndications, cryptocurrency, physical gold and silver. It's been interesting here actually, Amanda, at this conference, because so many people are not aware of the fact that they could take their IRA or 401k from their old job and move it into what we call a self-directed IRA and be able to actually have control and invest in what they know and understand and what they're passionate about.
Yeah, it's interesting that you say not a lot of people know it. And I think one of my questions is, why do you think that most Americans don't know we can use retirement money outside of the stock market into real estate and things like that?
A lot of it has to do with traditional financial institutions, advisors, financial planners. They're all geared to stock market based investment products. So mutual funds, ETFs, treasuries, so public market investments.
Yeah.
Whereas the ability to be able to invest self-directed into real estate, private equity, various other types of alternative assets, there's a very small percentage of the population that are doing this. It's a lot of family offices, high net worth, ultra high net worth individuals. And I'll also mention that the reality is this didn't exist until 1974, because that's when the ERISA laws were passed that then paved the path for IRAs, eventually the 401k, fast forward to the late 90s, Roth IRAs. So it's a combination, again, of traditional financial institutions just really not having the incentive to offer alternative investment opportunities like that.
Yeah.
And then the reality is it just hasn't been around that long.
Yeah. One of the things that really bothers me is I'll tell clients that, they can use, like you said, a work 401k that, they've left, they can move it to a self-directed account. But when they talk to their custodian, the custodians will say, oh, well, you can't do that. If you wanted to use your money for real estate, you have to, pay taxes and maybe penalties on top of it.
Right.
And what's so interesting is that they're not actually saying something wrong. They're just presenting an alternative way of how to, liquidate the account and then use it to buy real estate.
You're exactly correct. And I'll say, in some cases, there's some misleading occurring, right? Because a traditional financial advisor or financial planner, if that person's moving their money to a self-directed IRA, that's assets under management that goes outside of their purview.
Sure.
Now, all that being said, I've worked with many thousands of financial planners and advisors that are really good, and they understand that their client is good at real estate.
Yeah.
They have a track record, and they say, okay, you want to take X percentage of your portfolio and move it into a self-directed IRA with a financial custodian like Equity Trust. They have the ability to do that, and they're willing to allow the client to do that.
Right,
and then from there, they can self-direct. But rolling funds over, or transferring from an existing financial institution to a custodian that will allow them to self-direct is not a taxable event. But you're absolutely right. A lot of people have that fear that if they roll over or transfer money, that there's going to be a taxable event, or when they go and buy a piece of real estate or make a loan secured by real estate or invest in a real estate syndication, that they're borrowing against the account or they're distributing it and creating a taxable event, which isn't true.
Right. Yeah, it's like you said, it's misleading when people say that. And also, I think another common thing I've heard is they'll go to, for example, Chase or Fidelity, and they're told, oh, we can self-direct here. You don't have to move your money somewhere else. But again, also misleading, because when they say self-direct, they just mean you can choose between different stocks, bonds, and mutual funds, right?
Right, exactly. Yeah, so they can call it a self-directed IRA because, to your point, you can self-direct into mutual funds and individual securities.
Yeah.
But in terms of being able to self-direct into alternative assets, and when I say alternative assets, our clients want to invest not in like an alternative index fund.
Right.
They want to invest
Yeah.
in individual single family rental properties
Sure.
or a potential fix and flip property,
Right.
or they want to invest in a private equity fund or a hedge fund, or they
Yeah.
want to invest in a startup company. So for
Right.
example, I had a client recently, she's actually a real estate agent, and her name is Debbie, and she found a company that is developing AI software for real estate agent lead generation.
Oh,
And she's been a realtor for over 30 years.
Yeah.
So she said, hey, I'm going to take my knowledge and expertise in lead generation in the real estate space, and I'm going to put that to use,
Yeah.
finding this company and investing my Roth IRA into
Yeah.
this privately held company. Now, this could go to zero, right? It's a
Right.
high-risk startup company opportunity.
Yeah.
But if it ends up taking off, you know,
Yeah.
that could be a 10x or a 15x or a 20x multiple that's in her Roth IRA
Yeah.
tax-free.
Yeah, for sure. Love it. All right. So, what tax questions can I answer for you? What are some commonly heard ones, or any that you always wondered about with respect to?
A ton of tax-related questions
I'll
at
give
this
you
conference.
to ask two
Okay,
or three.
and yeah, and part of it is, as you know, Amanda, we do a lot of work with solo 401k plans. A lot of real estate investors are attracted to a solo 401k plan, the ability to contribute larger amounts, 70,000, 77,500 if someone's 50 and over,
Yeah.
the ability to invest in debt finance real estate and have the unrelated business income tax exemption.
Sure.
Very attractive to a lot of folks here. Here's the challenge. I've been speaking to a lot of folks here that maybe they have an S-Corp, maybe they don't, maybe they're not sure, but they're not really sure, are they paying themselves income? Do they have self-employment taxable income? And the understanding of owner draws versus W-2 income.
Yeah.
So I know that's a lot of questions to probably ask and unpack there,
Yeah.
but maybe if you could give some clarity again
Sure.
on how are real estate investors actually paying themselves? And if
Yeah.
they don't know what they're paying themselves, what should they
Yeah.
do?
Well, I think it's important to understand what type of real estate income that we're talking about first, because real estate itself is a generic term. So if I'm just earning rental income, usually that's not subject to self-employment or payroll taxes, which is good because we pay less tax. But the downside is it's also not earned income where we can then contribute towards retirement account. So if all I have is a LLC partnership, or if I own rentals in my personal name, that income does not allow me to make contributions to a 401k. Now, on the other hand, if by real estate income we mean you're a realtor, a broker, property manager, now those are active income. And so whether I earn that in my personal name or if I have an S corporation where I'm paying myself payroll out of, now that I'm eligible to use that money to calculate how much I can fund into a retirement account. We do rarely, infrequently, we do have clients who make so much rental income that we strategically then say, let's redirect. So maybe I'll have an S corporation and my rental entity will pay myself a management fee so that I now have earned income, do a payroll, and then fund a retirement account. I think the reason I say rarely is because what we're doing is we're shifting money from rental income to management income, which then I'm assessing self-employment or payroll taxes on. But for some people, you know, if I pay 15% payroll tax, but I get to write off my 401k contribution between federal and state taxes, 50%, that's still a win.
Right, right. And when folks are doing that, I'm assuming that the contribution that's going into the solo 401k plan is going to be on a pre-tax basis.
Yes.
Tax deductible, not into the Roth component of the solo 401k plan. Because the key is to get a deduction now.
Yeah, I mean, generally speaking, that's what when we look at that, that's what people are doing. But I think something similar to what you said, it just depends also on what the asset is. So I do have clients who are investing in, you know, pre-IPO kind of stuff that they think it's going to 10x or 100x in the next year. Then we'll say, well, let's skip out on the tax deduction, do a Roth, and then invest in the asset because it's more important for me to get that tax-free growth.
Right,
you know?
right. When you're working with a real estate agent, and I've met, gosh, I would say I feel like 25% of people that are at this conference right now are either their side business is they're selling real estate, they're a real estate agent, or they're a full-time broker. That's what they do.
Really interesting.
Do you, when you're consulting with an individual like that, whether it's their side business or it's their sole business, how do you make that decision or help them make the decision to transition to filing to be an S-Corp from their LLC or actually setting up like an S-Corp for tax purposes?
That's a great question because regardless of whether, you know, you're in the business of real estate or in the business of consulting or you're a CPA, The analysis is pretty similar. We're looking at what is the cost benefit of making that switch, of converting your LLC into an S-Corp. And so the cost, of course, is having the entity formed, filing a tax return for it, running payroll. So those are kind of the associated costs. And then we're looking at what is the benefit. And so the benefit really a lot of times depends on what is the net profit in the business. So for example, if my company netted after all expenses $100,000, by filing as an S corporation, I'm probably saving about $7,000 or more in payroll taxes. I mean, again, it's going to differ a little bit depending on what industry you're in, because you do have to pay yourself a reasonable compensation. But so the higher the net profit is in a business, the more the tax savings. And I think the other way could be true, where if my net profit after I write off everything is only $10,000, well, maybe now I'm only saving me a couple hundred in taxes, but I don't want to have to pay a CPA to file the tax return and do all that crazy thing,
Right. So 2 last quick questions. Reasonable compensation. How do you determine that amount?
Well, it depends on. In our firm, we actually use software that will do it. It'll pull information nationally from like the census and Bureau of Labor Statistics. So, but I think from a conceptual perspective, it's really taking a look at what is it that you do on a day-to-day basis as an owner of the business. And if you break out those tasks and you have someone else do it, what would be a reasonable compensation you would pay someone to do that? And I know it's so hard for a lot of our clients because, for a lot of our clients, they're like, well, I'm the rainmaker, I'm priceless. Yeah. You can't pay anybody to do what I do. But we just have to keep in mind, to be tax savvy, what we're trying to substantiate is the opposite, because the less payroll I pay myself, the more I'm saving on self-employment and payroll taxes.
Right. And then last question, this one should be quick, is I heard you speak at, it was the Passive Pockets event in Columbus, and you were talking about when you look at clients' tax returns, when you're onboarding a client and you look at their previous year's tax returns, that there's a percentage that you've determined of all the tax returns you've looked at that have mistakes, possible missing deductions, or just flat out errors. What is that percentage again?
And this is just in our
Maybe
firm.
It's increased since then. I don't know.
No, I mean, this is just in our firm, so it's not like a national study or anything. But about 40% of tax returns we see are not optimized for tax savings.
Wow.
And like you said, it's missed deductions, it's not optimizing depreciation, wrong entity structuring. So it's unfortunate, but I think that also helps to reinforce one of my passions, which is educating people on what they can actually do to save on taxes. Because we can't always just rely on the CPAs to do it. CPAs are there's not that many good CPAs. And I think I just saw a study that almost 70% of CPAs are going to be retiring in the next 10 years.
Wow.
So I feel like the problem will get worse. And so it's always up to us as individual taxpayers to educate ourselves on what we can do as well.
Yeah, I love what you say about how, there's people in the medical world, they specialize in certain areas, right? Dermatologists,
Yes.
I'm not really great at knowing all the names, right? But
that's good. That means you're healthy.
Yeah, exactly. Yeah. So, but with CPA specifically, you're looking at a real estate CPA, like you're practicing in real estate every day. As you're looking through the One Big Beautiful Bill, you're focusing on the real estate sections and bonus depreciation and everything else that goes along with that. So I think that's really smart, and I appreciate that. We have a lot of clients that I know utilize your services, so we appreciate that, and I appreciate everything you do.
Awesome. Thank you. Thanks for joining us.
Yeah.